in our 20-year history. I think our market position keeps getting stronger. We're now 12% of all US e-commerce. Last year alone, something like 875 million consumers bought something from a Shopify store. And I think our operating model is really working. For the year, we hit 300 billion of GMV. That's up 24%.
As you pointed out, we've got an upgrade coming from BNP Paribas to outperform price target $254 up from $200. This is a stock that most investors would know has been dominating the e-commerce and the cloud segments for quite some time.
Some investors are pointing out the impact on foreign low-cost competitors. So think of names like Shein and Temu, which could be some consolation for Amazon. So a bulk of items available on Amazon do come from China, mostly through those third-party sellers.
The 2025 tariff adjustments were supposed to be a death sentence for US e-commerce. Every major headline has been filled with doom and gloom, painting a picture of collapsing supply chains and prices going through the roof. The story has been written, this is a crisis, but what if that story is dangerously incomplete? What if, while giants like Amazon are scrambling and platforms like Etsy and Shopify are watching their sellers get crushed, a handful of companies are quietly turning this chaos into a massive win? These companies aren't just getting by, they are perfectly set up to thrive in this new world. Today, we're pulling back the curtain on the specific companies benefiting from the fallout. We'll break down exactly how they insulated themselves from the storm and why they're seeing surprising growth while everyone else panics. This is the story the financial news isn't telling you.
So there is an impact. Prices are likely to go higher. The upside, tariffs are taking aim at a trade loophole. It's gotten a lot of attention. It's helped Amazon's competitors, Shein and Temu, as I mentioned. They've skyrocketed in popularity really by undercutting on price, and they've used what's known as the de minimis exemption, which lets exporters ship packages worth less than $800 into the U.S. duty-free.
Section 1, the problem, a tariff bloodbath for the giants. To really understand why a few companies are winning, you first have to see the scale of the carnage for everyone else. The 2025 tariff adjustments weren't just a small policy change, they were a shockwave sent right through the heart of the e-commerce model we've known for 2 decades. So, what actually happened? It comes down to 2 catastrophic changes for businesses that rely on Chinese imports. First, the long-standing de minimis rule, which let packages under $800 enter the US duty-free, came under fire. While not fully eliminated, that free pass is now facing intense scrutiny, with new restrictions and enforcement making it a minefield. For the dropshippers and fast fashion brands who built their empires on that rule, the ground has completely shifted beneath their feet. Second, tariff rates on certain goods from China were hiked dramatically. We're talking about sustained increases in the 25 to 35% range for many key categories, with some outliers facing even steeper rates. Think about that. A product that used to cost a company $100 to import could now cost them $135 before it even hits a warehouse. This wasn't a speed bump, it was a brick wall. The entire financial model for importers was thrown into a wood chipper, creating a supply chain earthquake that's bringing down the unprepared. Let's look at the casualties, starting with the biggest of them all. Amazon, the everything store, suddenly couldn't control a key part of its business, the cost of goods for its third-party sellers, who are the backbone of the platform. The impact is staggering. For example, a simple smartwatch that a seller used to import for about $12 now sees its landed cost jump to nearly $20 thanks to the new tariffs. That's a huge increase before a single dollar is spent on marketing, shipping, or Amazon's own fees. This has created an operational nightmare. Sellers are facing longer customs delays and a mountain of new paperwork. You might think, why doesn't Amazon just show the tariff costs on the product page? They reportedly looked into it, but faced immense political pressure and had to back down. So the giant is stuck. It can't fix the problem for its sellers, and it can't even be fully transparent about it, leaving its marketplace in a state of quiet chaos. But this isn't just a problem for huge corporations, it's devastating for the small businesses on platforms like Etsy. Etsy's brand is built on unique, handcrafted goods. But where do many of those crafters get their raw materials? China. We're talking about specialized fabrics, jewelry components, beads, and even their shipping boxes. The impact has been brutal. One analyst found a real-world example of an Etsy seller whose regular $400 order of custom packaging from China now costs over $700 after tariffs. That's a direct hit to their bottom line, money that can't be reinvested into their craft. This isn't a theory, it's a tax on creativity. We see the result in Etsy's own numbers. The platform's gross merchandise sales, the total value of all goods sold, has been under serious pressure. People are buying less, likely because sellers are being forced to hike prices. And here's the cynical part. During this same period, Etsy's own corporate revenue has managed to grow, thanks to increased ad and seller fees. Think about that. As its sellers get squeezed, the platform squeezes them even harder to make up the difference. It's a death spiral, fueled by tariffs. This brings us to Shopify, the platform powering millions of independent online stores. Shopify itself doesn't sell products, but its merchants do, and a huge number of them built their businesses on Chinese manufacturing. That entire ecosystem is now under extreme pressure. Their merchants are facing the same shrinking margins and supply chain chaos we've already seen. This pressure is reflected in Shopify's performance. As of May 2025, its stock price was down over 13% for the year, with analysts pointing to the new tariff regime as a major headwind for its merchant base. The promise of Shopify is that anyone can build an e-commerce empire, but that promise gets a lot harder to keep when the basic economics are blown apart by trade policy. So if Amazon is stuck, Etsy's heart is getting squeezed, and Shopify's ecosystem is under threat, it begs the question, where is the smart money going? Who is actually winning here? Section 2. The solution, the rise of the tariff-immune stocks. Now that we've seen the damage, let's look at the companies turning this crisis into an opportunity. While most of the market focused on the fallout, a specific type of company was perfectly positioned not just to survive, but to gain a massive edge. The winning formula is surprisingly simple: a domestic supply chain combined with a direct-to-consumer DTC sales model. Think it through. If a company makes its products here in the United States, it's almost completely insulated from tariffs on Chinese goods. The entire circus of import duties and customs delays just doesn't apply. But it gets better. Not only do they avoid the pain, they directly benefit as their competitors suffer. As rivals who import from Asia are forced to raise their prices, the domestically made product suddenly looks far more competitive. The Made in USA label has transformed from a patriotic slogan into a powerful financial moat. The second part of the formula is selling directly to customers online. Companies that control their own websites have ultimate control over their pricing, brand, and profit margins. They aren't held hostage by a marketplace like Amazon that takes a huge cut. In fact, some of the smartest companies are intentionally selling less to wholesale partners to focus on their much more profitable DTC channels. They're choosing to own the customer relationship, and in this new world, that's everything. Let's look at the companies that prove this strategy works. Our first is a company you definitely know, but its strategic advantage right now is deeply underappreciated. Whirlpool, stock ticker WHR. Whirlpool is an iconic American brand, owning names like KitchenAid, Maytag, and Jen Air. The key is where they make these products. The vast majority of their appliances are manufactured in factories across the United States, with a heavy concentration in Ohio. This has been their model for decades, but in 2025, it's become their greatest asset. While competitors wrestle with how to import a refrigerator under a massive new tariff, Whirlpool is building them in America, completely shielded from that chaos. This gives them an incredible edge. A competitor importing a similar appliance from China now has a huge, unavoidable cost disadvantage. They either have to eat that cost and crush their margins or raise prices, making Whirlpool's products look even better. This is a powerful tailwind that could let Whirlpool steal significant market share. On top of that, Whirlpool has been investing heavily in its own e-commerce channels. They know people are now comfortable buying a dishwasher online. By selling directly, they capture the full profit from the sale. They even offer a brilliant shareholder perk: own just one share of their stock, and you can get 30% off your next purchase from their website. It's a genius way to build loyalty and encourage the very DTC behavior that is so profitable for them. Our second example is in a completely different business, but follows the exact same playbook. Thor Industries, stock ticker THO. Thor is the largest manufacturer of RVs in the world. They own brands you've definitely seen on the highway, like Airstream and Jayco. And just like Whirlpool, their manufacturing base is their superpower. Thor's operations are heavily concentrated in the American Midwest, especially Indiana and Ohio. They build their motorhomes right here in the USA. The tariff angle is obvious. While an RV has thousands of parts, the vast majority of the cost and value, the chassis, the body, the assembly, is domestic. Any competitor trying to import even partially assembled RVs would be at a crippling disadvantage. The market for Thor is also incredibly strong. The pandemic accelerated a trend towards domestic travel and the outdoor lifestyle that has refused to fade. RVs are the ultimate made-in-America product, both in how they're built and what they're for. They are built for exploring this country. This gives Thor a powerful story that lines up perfectly with its tariff-proof business model. Now for our third example, I want to show you how this strategy can work even for a company that isn't technically made in USA. This is a fascinating case study. Canada Goose, stock ticker GOOS. Canada Goose is known for its premium winter jackets with premium price tags. You might think a global luxury brand like this would be exposed to tariff wars, but their setup is a work of strategic genius. Here's the key. According to the company, around 75% of all Canada Goose products are made in Canada. Thanks to the US-Mexico-Canada Agreement, USMCA, these goods are currently exempt from the new tariffs. The rest of their production comes from Europe, which is expected to have only a minimal financial impact. So while brands relying on Asia get hammered, Canada Goose has a free pass because of its geography. But that's only half the story. The other half is their aggressive and wildly successful push into direct-to-consumer. Management has been very clear about their strategy. They are intentionally cutting back on selling to department stores to focus on their own retail locations and their high-margin website. The numbers are stunning. In a recent quarterly report, their DTC revenue jumped nearly 16%, while their wholesale revenue, by design, fell over 23%. This shift is supercharging their profitability, with gross margins hitting record highs approaching an incredible 70%. A traditional retailer would be lucky to have margins half that size. The Canada Goose story is a masterclass in how to thrive in this environment. If you're getting value out of this breakdown and want more analysis that cuts through the noise, do me a favor and take a second to hit that subscribe button. It's free and it's the best way to support the channel and make sure you don't miss what's next. So if that's what's happening right now, a smart investor has to ask, what's next? The tariffs have set off a corporate scramble to do one thing: get out of China. Companies are desperately trying to move their manufacturing to friendlier countries, or even better, back to the United States. This massive industrial shift is creating a powerful investment theme. You can invest in the picks and shovels of this reshoring gold rush, the companies that will provide the essential materials for this new wave of American manufacturing. A prime example of this is Nucor, stock ticker NUE. Nucor is the largest steel producer in North America. They operate mills across the US and, crucially, they specialize in using electric arc furnaces to turn recycled scrap metal into new steel. Their process is efficient, domestic, and cleaner than traditional steel making. As companies start building new factories and retooling old ones on US soil, who will they turn to for the steel they need? They'll turn to domestic producers like Nucor to avoid the very supply chain risks they're trying to escape. Nucor is a foundational beneficiary of the entire reshoring trend. The tariffs that punish importers are the same tariffs that are driving Nucor's future customers right to its door. So let's put it all together. The 2025 tariff adjustments have acted as a great filter, ruthlessly punishing the business models that dominated e-commerce for 20 years. Companies like Amazon, Etsy, and Shopify, built on a foundation of cheap imports from China, are now facing a brutal reckoning. But this chaos has created a stark divergence in the market. The losers are the companies with fragile, overextended supply chains. The clear winners are the anti-fragile companies, the ones who control their own destiny through domestic, tariff-proof manufacturing and a direct, high-margin relationship with their customers. We've seen how this plays out with Whirlpool, using its American factories to gain a pricing advantage. We've seen it with Thor Industries, whose American-made RVs align perfectly with a powerful consumer trend. We've seen the genius of Canada Goose's geography-based tariff shield. And we've looked ahead at the picks and shovels plays like Nucor, who are set to win from the long-term trend of reshoring. The big question now is whether this is a temporary shift or the dawn of a new era of American industrial renewal. What other companies do you think are secretly winning in this new environment? Drop your thoughts and your best ideas in the comments below. I read every single one. And finally, if you want to be the first to know about our next deep dive into the stories the rest of the market is missing, make sure you're subscribed with notifications turned on. Thanks for watching, and I'll see you in the next one.